Hello fellow intelligent investors. I guess if you've spent some time reading about investing, you've probably come across the term buy the dip. Basically, this strategy refers to the idea of buying an asset. So this could be a stock, an index fund, cryptocurrencies, or even real estate, shortly after the asset's price has fallen a certain amount or a certain percentage. Now this sounds like a good investing strategy, doesn't it? You are basically buying something for a cheaper price than it was trading for a while ago. Well, in this video I will argue that if you are a long-term investor, buying the dip might actually be a terrible strategy. And I will explain why a buy the dip investment approach doesn't work the way you would intuitively expect. So without further ado, let's get started. Alright guys, so I would argue that the buy the dip phrase probably makes multiple media headlines every single day of the year. But what exactly does the phrase refer to? Let's quickly define what we will be talking about in this video before we move on. So, according to Investopedia, buying the dip refers to the purchasing of an asset after it has dropped in price. The belief here is that the new lower price represents a bargain, as the dip is only a short-term blip and the asset, with time, is likely to bounce back and increase in value. And just to provide you one example here, let's consider the stock of the subscription, streaming, entertainment behemoth Netflix. If we just consider Netflix 7-year stock chart, you could argue that a buy the dip investor would have bought the stock on around 5 occasions. Probably here, 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 and here. Let's assume you started investing in October 2014 and saved $100 each month. Once Netflix stock is down a significant percentage from a previous all-time high, you would then invest all of that saved up cash. Those are basically the 5 occasions that we have just pointed out. After deploying your cash reserve, you'll go back to saving up cash mode and wait for the next market or stock dip. And if that would be your investing strategy, then you would have invested $1,700 on the 12th of February 2016, $3,000 on the 17th of August 2018. You would have deployed $400 on the 18th of December 2018, another $1,000 on the 4th of October 2019, and then another $500 on the 13th of March 2020. And since that last significant price drop in March 2020, you would have saved up another $1,900 over a 19-month period. And if you now add up all of these investments, you'd be sitting on $23,842. Not a bad result considering your total amount invested over this 7-year period is $8,400. Now, in the introduction of this video, I think I made quite a provocative claim, right? I said that a buy the dip investing strategy performs terribly. Well, this may be a bit of an exaggeration, but the point is that there may be an alternative strategy that tends to work better. So, what's the alternative that we should consider? Well, an alternative investing approach is dollar cost averaging. And if we reference Investopedia again, then we could define dollar cost averaging as the practice of systematically investing equal amounts spaced out over regular intervals, regardless of price. So instead of opportunistically buying Netflix stock, for example, after sharp price drops, you are regularly investing the same amount. For instance, you could buy Netflix stock on a monthly or quarterly basis and then buy the stock here, 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 and so on and so forth. If we go back to our example, the investor that has $100 a month available to invest. Well, this would mean he or she would invest $100 each month for the entire 7-year period. Again, your total contribution would be $8,400, $100 per month over an 84-month period. But obviously your performance would differ. We can use a dollar cost averaging calculator and figure out that after the 7-year period, we'd end up with $32,325, beating the buy the dip investing approach. Now, obviously, we used a very specific example here. We looked at one specific stock over a very specific 7-year period. This is certainly a very limited sample size, and it tells us practically nothing about the superiority or inferiority of either investing approach. Of course, there will be specific stocks and time periods where the buy the dip strategy will actually vastly outperform a dollar cost averaging strategy. So what we will do next is we will consider a broad market index, the S&P 500, which is made up of 500 stocks. And we will consider this index benchmark over longer time periods, and more specifically over various 20-year periods. And then again consider if either of the two approaches should be your preferred choice. But before we do that, I just want to quickly highlight that we made one assumption in our Netflix calculation. And that is that we could almost perfectly time the bottom of the dips. In reality, this is practically impossible. Perfectly timing the bottom is in fact absolutely impossible, because a bottom can only be declared in retrospect. To quote Howard Marks here, he once said, "We never know when we're at the bottom. A bottom can only be recognized in retrospect. It was the day before the market started to go up. By definition, we can't know today whether it's been reached, since that's a function of what will happen tomorrow." So if we consider this, I think it should be even more surprising that in our Netflix example, a buy the dip strategy actually underperformed, even though we had perfect foresight and timed the dips of Netflix stock almost perfectly. Just how difficult it is to time stock or market bottoms can be nicely illustrated with so-called stock market timing games. You can find plenty of these games online, but I'll add a link to the one I'm showing you here today to the description box down below. Basically, you just click the start button here to start a random 10-year period of the US stock market, which is represented by the S&P 500. You then just click the buy or sell button to buy and sell your investment. And then you, of course, try to take advantage of bull markets. This is what is commonly referred to as sell the rally, while trying to exploit market crashes or market dips, what we refer to as buy the dip. And you can then compare your performance to a typical buy and hold strategy. And as I said, you will realize that beating the market by timing market ups and downs is an incredibly difficult exercise. All right, let's consider how a buy the dip strategy would have worked if we consider a longer investment time horizon and a broad market index as the underlying asset. I came across a truly phenomenal blog post by Nick Maggiulli. I hope I didn't butcher his name here. Anyway, the blog post was titled "Why Buying the Dip is a Terrible Investment Strategy." And that write-up basically inspired me to do this video. And the author, he also distinguished between a dollar cost averaging strategy and a buy the dip approach. But in contrast to the Netflix example I used in this video, the buy the dip approach the author used for this blog post was much more systematic, as he defined very specific thresholds. So for his calculations, just like in our example, an imaginary investor saved $100 each month in cash, but he or she then invests the accumulated savings all at once the market index dips below a certain amount from its all-time high, for example 10% or 20%, and then continues investing $100 each month until the market hits another all-time high. So that's another important distinction to our Netflix example. Nick Maggiulli showed that a buy the dip strategy actually slightly outperformed dollar cost averaging during some 20-year periods, such as the 1970 to 1990 period, which had a 40% drawdown quite early in this 20-year period, and it also outperformed in the 1963 to 1983 period, which was actually the best 20-year period for a buy the dip strategy relative to a dollar cost averaging approach. However, and please pay attention now, Maggiulli also showed that there are actually many more periods where the beloved buy the dip investing approach did not perform so well. Especially if you are going for a high dip threshold of 40% or more, you performed terribly during some periods, as there were simply no such dips during these periods. You would basically just sit on cash, which is a miserable long-term asset. Over a 20-year period, cash basically guarantees you negative real returns. So the biggest risk of a buying the dip approach is that the market starts out strong for a sustained period of time, during which it never experiences any significant price drops. And this is something I actually addressed in my last video, in which I stressed the risks of sitting on too much cash for a relatively long period of time. If you miss out on annualized returns of around 10% for, say, 2, 3, or 4 years, it is just very, very hard to ever come back from this deficit. All right, let's get back to the calculations done by Nick Maggiulli. I won't get into too many details here, and I'll add a link to the wonderful work he has done to the description box down below. But basically, the author showed that however you define your dip threshold, 10%, 20%, 30%, or even 40 or 50%. Buy the dip approach more often than not actually underperformed dollar cost averaging over random 20-year periods between 1920 and 2020. In fact, the higher you buy the dip threshold, the more you lack the broad market performance. Now, in a fairly short YouTube video like this one, you can't get into all of the details of both approaches. I actually do believe that having some cash can provide some value, and this is actually something that is commonly referred to as the option value of cash. However, there are also risks that come with cash as an asset class, but I think I have very clearly shown that at least passive investors should certainly favor a dollar cost averaging approach and avoid a buying the dip strategy. Let's say you happen to successfully take advantage of a major price decline, missed the market provided to you early in your investing career. Just consider yourself lucky, but then switch to a dollar cost averaging autopilot approach. If you are an active investor, things are a bit more tricky. I'd say there are a couple of things that you should be aware of. Let me just mention 3 here in this video very briefly. First off, anchoring buyers. Put it in a nutshell, just because the price of an individual stock has declined, this does not mean that the new, seemingly cheaper price is actually cheap. It might be relatively cheap relative to previous all-time highs, but the stock might still be expensive in an absolute sense. Secondly, a share price might actually decline, say from $10 to $8 a share. But what if the business fundamentals actually also deteriorated and the price decline is actually justified as the intrinsic value of that business declined as well? And then lastly, as an active investor, you are of course waiting for market corrections. However, you are not just limited to 1 or 2 index funds. No, instead, you can basically look at hundreds or thousands of stocks, and thus the risk of just sitting on too much cash for a multi-year period is obviously much lower. So those are just 3 things worth thinking about a little more, but I'll leave that up to you. Make sure to give this video a like and leave a nice comment if you want to support this channel and the work I do here. And as always, may your finances and investments prosper. Good luck!